Hello, everyone, and thank you for joining us at BFA for today's webinar, A Fintech Approach to Financial Inclusion, as part of Financial Inclusion Week. My name is Carmen Merab. I am part of the Insights and Inputs team at BFA, and I will be your host. BFA, for those who are unfamiliar, was founded in 2006. We are a global consulting firm specialized in using finance to create solutions for low-income people. We use an interdisciplinary approach and integrate customer insights, business insights, inclusive fintech, policy and ecosystem development, and finance for life in our work to design and implement solutions. Today's presentations showcase three of BFA's programs, Catalyst Fund, FIBR and OPTIX, working hands-on with innovators and financial service providers, using different approaches to create meaningful financial solutions for low-income people. At this time, I would like to invite our first presenter, Mylis Carraro.
Thank you, Carmen, and hi, everyone. I would like to start by giving you some context of why we decided to talk to you about fintech approaches to financial inclusion. In the context of financial inclusion at BFA, we firmly believe that fintech holds boundless potential to really transform the way that financial services are offered and provided to low-income customers in emerging markets. We believe that fintech is an approach, and that these digital tools really create opportunities to increase the speed, the accountability, and also the efficiency in the way that financial services are offered to low-income customers. So we work with different players in the ecosystem and obviously in emerging markets. And today we'd like to show you some of the different approaches that we embraced, working with early stage innovators, with later stage growing businesses, and all the way to establish financial institutions to embark in this innovative, to promote this innovative financial services offerings for the low-income customer. So the first program that we work on and that I manage and I'd like to present to you is called Catalyst Fund. Catalyst Fund accelerates innovative global early stage fintech startups to spur innovation in financial inclusion in emerging markets globally. So it was started actually to address a common problem that we often see with early stage startups in the inclusive fintech space. They, and actually not only in the inclusive fintech space, but more broadly, they always have a hard time at that early phase securing the capital and the expertise needed to complete and test their products and get to market. So what this means is that often innovative ideas in these markets fail to see the light of day and never go past the PowerPoint deck stage. So 2 years ago, a group of impact investors actually came together and shared this common concern that many times they would see great teams with innovative ideas and innovative technologies, but they were just too early for them to make an investment, even when it was, for example, seed stage investors. But these teams, didn't have the traction yet, didn't have enough talent in the team, didn't reach enough proof points for them to feel comfortable in taking the risk in investing in the innovation. So Gates Foundation and JP Morgan Chase decided to come together and create this philanthropic fund, Catalyst Fund, that could address this gap in the market. Since 2016, when the fund really got started, we started deploying about $2 million in grant capital to these early stage fintech innovators and about $1 million in tailored advisory services, with the goal of reaching about 20 startups globally by the end of 2018. And the fund doesn't work, just with the donor, but really looks to the investors to select the most promising, best performing teams in these markets. So we have our investors partners that form the selection committee. Those are Axion Venture Lab, Gregos Ventures, the Media Network, Quona Capital, and 500 Startups. And they are the ones that select the startups to sponsor to the program and provide mentorship to them. Then BFA, our firm, who manages the fund, provides a technical assistance to the startups. and works with them to really de-risk them and take them to validate those proof points so that at the end of the program, the investors might feel more comfortable in actually making an investment in them. And then finally, the main protagonist, obviously, of the programs is the startups themselves. So far we have supported 14 fintech companies. And as I said, we'll get to 20 by the end of 2018. But I'll tell you a little bit more about them in a moment. And finally, because it is so important to, at the tail end of the program, being able to see that there are opportunities for funding, we also created a circle of investors. The circle is a broader group of investors, both impact investors and commercial investors, that can watch the progress of the startups and be matched with those that really fit the investment mandate and criteria. So we do double-blind introductions. We always ask also, of course, if the startup is interested in collaborating with a certain investor, and try in that way to facilitate and growing this company, facilitate introductions and growing these companies over time. So how does this all work in practice? So Catalyst offers grant capital, really flexible seed grant capital up to $100,000 per startup, coupled with the mentorship from the investors, and also very tailored hands-on advisory services from BFA that really meets the needs of the startups. And we don't want to do all of this in a vacuum, just to support these 20 innovators. We also have a broad learning agenda. And the objective of the learning agenda is to really gather insights from the work and the engagements with each of the startups, and then share the lessons with the broader sector and the industry. So the learning agenda poses key questions, we think, to advance the fintech for inclusion space overall. And we hope that these findings will be relevant for accelerators, for example, answering, for instance, questions around the facility itself. How does this facility type actually work? Is this model better than other models out there that you might be familiar with? For example, village capital models or others that are trying to support fintech startups as well. And we also try to answer questions for the benefit of the startups. So can, digital financial services products be 10 times better than other traditional options? What barriers do fintech innovators face, and how can we overcome them? And then finally, also lessons for the ecosystem. What are the elements of an ecosystem that need to be in place for fintech innovation to really thrive in a certain market? So our portfolio right now ranges, a number of products and business models. We've got 14 startups so far, and they're extremely diverse, both in terms of the product and the underlying technological innovation that they leverage. So we have, for example, many insurtech companies leveraging chatbot for client communication. We have several credit scoring companies or mobile credit companies that utilize mobile and alternative data sources such as bill payments to improve their credit scoring assessments. Or, for example, digital identity recognition startups that use artificial intelligence and face recognition to facilitate the authentication and increase trust between the lenders and the borrowers, for example. And these cover 3 continents. They span really across the globe because we don't have a mandate to focus on one region specifically. So right now we have the bulk of them are in Sub-Saharan Africa, also Latin America and South Asia. And we're looking to expand in our next cohort to Southeast Asia, for instance. So it's really global in nature, which allows us to have a broad reach, but also see what kind of innovations are emerging in different markets to respond to the needs of low-income population in these markets. And the one thing that really we believe differentiates this program from others, and the one thing that all startups appreciate the most, is actually the tailored technical advice. So startups really feel that when they enter the program, they get an extension of their team for the 6 months that they work with us. And that's because BFA has the luxury of having over 40 experts on diverse topics that can really help on anything from consumer research and value proposition design to product architecture and product roadmaps development, or acting even as the interim CTOs for the companies building their technology. or machine learning techniques, for example, to optimize business processes, to and then all the way down to, for example, more strategic business advice on partnerships and also regulatory support, for example. So I wanted today to give you a sense, a bit more detail of how we supported some of the startups at this stage. So the very first startups we supported is a company called the Stockman. The Stockman is an alternative credit scoring platform that uses bill payments history and also other alternative data to create a behavioral score and assess individuals' creditworthiness for individuals that before were invisible to the credit scoring system. So the Stockman really gives an opportunity to excluded segments to demonstrate they are good payers and provides financial institutions on the other end with data for people who were previously invisible and the opportunity to offer them, for example, sometimes their first time loan ever. So, and the Stockman additionally also allows the users themselves to access their credit reports for free, so that people can really check out their financial health and understand their chances of getting a loan and also improve on their score. So it's revolutionary in the sense that the ownership of that data is also put in the hands of the users themselves, and they can therefore understand the data sources and build better habits and gain access later on to even better product offerings if their credit score improves over time. So with them, we realized that they needed to improve their credit scoring models to increase revenues and lead to better sales with the financial institutions. So our data scientists and our quantitative analysts in the team helped the Stockman to enhance the predictive power of the credit scoring algorithm through machine learning techniques, so that I could better predict defaults, which basically means identifying the good payers and the bad payers more accurately. And this is very important because a better model obviously translates into better financial advice and also access to more products that suit the needs of the underserved. And on the other side of the equation, we use our business insights capability to make the case for financial service providers to really invest in high-tech credit scoring. Because oftentimes the sales cycles with the banks and those partnerships are really difficult to achieve. And they really need to make the case that they are better off using a product like the Stockman versus their internal credit scoring models. So we worked on them on an ROI model, return on investment model. And with these two pieces, we really saw the power of integrating machine learning and then actually communicating that value to the financial institutions to facilitate a better marriage between the two, a fintech and a bank and the banks. Another startup that we worked with, it's called PayGo Energy. PayGo Energy operates in Kenya and provides clean and affordable gas on a pay-as-you-go basis. So their micropayment structure, pay-as-you-go micropayments, aligns with the existing consumer spending habits to overcome the major cost barriers that consumers face at the beginning when they have to purchase, for example, a huge gas tank. And so they enable stable supply of cooking gas for any family by using that. They also use smart meters on top of the gas tanks to really monitor customer gas consumption and predict when gas is going to run out, which really allows the families to immediately reorder and eventually even ask, for example, cash advances. I need to reorder, I'm running out. PayGo will know, and immediately a delivery guy will show up at the doorstep with a new tank, for example. And when we first started talking to PayGo, a very innovative idea, leveraging a technology that in Kenya is widespread, they had, I think, 1 or 2 customers. So extremely early, but great potential. And with them, we worked, for example, on designing their product architecture overall and developed a pilot product through off-the-shelf software modules that were already existing out there. They just needed to basically connect and make work for their own service so that they could start operating and really validating their idea in the market with their customers. And then on the other end, we also conducted research with their existing few customers to see, for example, what were the points in which they were creating or destroying trust with the customers, how they could build more trust, because obviously if the gas blows off, it's a very big issue. Nobody wants to go there, and therefore improve retention over time, and really that relationship with the customer that can get them to scale. So these are just two flavors of what we've done, but there's so many more insights and also tools that we've offered to the other 14 startups. And you might be wondering, how can we share these tools and tips to learn to benefit other early innovators? So rest assured, that's a question that we've asked ourselves from day one. And so we're creating a series of toolkits to help startups in their journey towards product market fit. For example, as I mentioned earlier, trust is a very, very important topic for the startups, building trust with customers and retaining them, particularly when you're a new entrant in a market and nobody knows you, nobody knows the product you're offering, even if it's the most incredible innovation. So the first toolkit we published, it's called In DFS with Trust, or DFS Trust Toolkit. And it helps startups think about from the customer journey perspective. Where and how can I build more trust with my customers, from product design to product delivery? And now we're working on a series of other tools. For example, a self-diagnostic to determine critical risk areas for the startups, a product market fit toolkit in and of itself, which helps the startups with various frameworks to reach that point where they feel comfortable their solution is needed and they have a solid business model. A data readiness toolkit, a guide to leverage data for product and business decision making. What data do you need? How much? How do you crunch it? And how do you analyze it? And then finally, also a artificial intelligence strategy toolkit, because we're seeing that a lot of the startups could start leveraging sometimes machine learning approaches. And it's very important, therefore, to have a clear understanding of how you can deliver value for your business using an AI approach. So let me pause here and give you a chance to ask a few questions before passing on to my colleague, Abby.
Mylis?
Mm-hmm.
We have a question from Janet. She says, these toolkits are very interesting. Which are the most popular or requested by the startups you work with?
Well, as I said, at the moment, we've only officially published one, but we have seen, and we are testing the second one, which is a risk toolkit. But so far, I can say the two ones that they all rave about are the DFS Trust toolkit, because again, it's such a main pillar for the startups is to build that trust early on with the consumers. And the other one is the product market fit toolkit. How do I run experiments to validate my idea? How do I gather the data and then analyze it? How do I ask the right questions to consumers through, for example, questionnaire surveys, focus groups? Like all of these techniques in the early days are very important. So those are the two main ones. But I think probably all of them will deliver some value depending on at what stage the company is at.
We have another question from Dia. What has been your most successful approach, toolkit, to make partnerships between startups and institutions easier?
That is a very, very good question. There is actually a toolkit that we use already that one of our partners prepared, Axion Venture Lab. And it's a deck of how you approach financial institutions when you are trying to do an enterprise sale. So it walks all the way from, and it's a public toolkit, by the way, so you can access it from their website or from our website under resources. And it walks all the way from who to talk to, how to frame your pitch, what to say, and what to expect in terms of timelines, so that you enter with a full knowledge of potentially how difficult it is to make that sale. And it's a very useful one. And we're also working on that topic with our startups. And Venture Lab does offer sometimes technical assistance to our startups as well. So we complement each other very well in that regard.
Another question, what is the most interesting thing you've learned so far?
Many interesting things. I don't know if I could pick one, but I'd say from a facility perspective, I think a big realization was that in the early days of these businesses, it's extremely important to move to execution, a very hands-on and agile execution where you can test your idea quickly, iterate, and then basically go to market with the most perfect minimum viable product. And so a lot of the programs that are out there often give too straight-jacketed curriculum of, for example, how do you build your business 101? And that is not necessarily what the startups need at a time where they need to think through different challenges and need the flexibility. So being able to offer them that flexibility and basically get our hands dirty with them, with the real problems they're facing, has been extremely helpful. And being a former entrepreneur myself, I can say, I wished I had I had this type of support early on.
The last question we are taking now, we'll answer the rest of the questions at the end of the session. And if you don't know how to ask a question, there's a Q&A tab at the bottom of the screen that you can use. The last question is, what else is missing in the ecosystem that can spur innovation for fintech startups?
Very good question again. And a thing that we're seeing is that in a lot of the emerging markets, there's a lack of exit strategies for the startups. And that, could, for example, be, and not just exit strategy, but also some often lacked to access to data. So trying to set up, for example, a data commons so that startups could access pools of data to utilize and iterate on to improve their products and services would be a great plus. And then the other is better access to networks of investors or networks of banks, networks of accelerators, where there's more potential for sharing ideas and potentially even M&A deals for the companies. So, that's two things we're seeing in the ecosystem, and I won't even go in the more infrastructural issues and regulatory issues that you have in these markets. But there's many of those barriers.
Thank you, Maëlys. Our next presenter is Abigail Steinberg from FIBR.
Hi, I'm delighted to be joining you all today, and thank you for taking the time. I am the program manager of FIBR, which is Financial Inclusion on Business Runways. And similar to Catalyst, we're also a multi-year anchor tendency, working with fintechs, but we're also working with tech startups. Our project partners are quite a bit beyond seed stage, but they definitely need kind of hands-on technical support. So the rationale for FIBR is that traditional financial channels have been limited in reaching low-income individuals. With the exception of Kenya, now that we've seen 10 years after the launch of mobile money, we've seen limited traction for financial services through these kind of more traditional channels, such as banks or even mobile money agents. Mobile money has not scaled to the same extent in other markets. Our focus markets are Ghana and Tanzania, as we have seen in Kenya. And inactive bank accounts and other accounts are still kind of the norm within these environments. The approach to date has been quite top-down. So FIBR seeks to build financial services into the networks that people are already interacting with. Sorry, I'm just going to go back a slide. Thank you. On a daily basis. So instead of pushing financial services onto people, we hope to build services that meet specific needs and pull transactions naturally. The project benefits from the fact that many of these businesses or networks that low-income communities are interacting with already have smartphones or digital devices that can be tools for capturing rich data and information. So far, we have worked with 6 project partners. We have deployed the FIBR model in a number of sectors, including agriculture, education, PayGo Solar. In addition, we have worked with agent networks, and we're beginning to dive into the retail sector. Our focus is really on digitizing these last mile delivery channels, beginning to capture, leverage that data, deploy data analytics, machine learning, and explore ways to bring in financial service providers in order to use these channels to begin pushing or supplying really relevant digital financial services. And with that, I'm delighted to hand it over to my colleague, Sushmita Mecca. She's the FIBR Learning Manager.
Great, thanks Abby, and hi everyone. So building on what Abby said, FIBR seeks to explore an alternative approach to financial inclusion and build upon those networks that people are already interacting with on a daily basis. So networks of schools, the retail corner shops that people visit on a regular basis, and more recently, PayGo distribution networks, which we'll talk about in a few more slides. It is an action research project, meaning we work with partners to prototype and test approaches with the objective of building learnings about the feasibility of this approach through 3 key questions that guide our work. So the first question is, what is the best way to actually digitize the data that is at these businesses? We see lots and lots of paper ledgers and other paper records in the form that you see in these photos. And even with smartphones and laptops, as you can see in the top picture, most of these businesses are not yet using these devices to capture that data. So we work with these businesses to either build on top of the devices that they have and build systems that can actually capture this data in a format which is usable and provides insights into customers. The second question that you see is how these networks and whether these networks can actually serve as channels for financial services. So the example that you see illustrated here shows the process that we developed with FIBR partner IT Consortium in Ghana to provide a solution for collecting school fees. In this case, we were seeing that low-income parents were struggling to pay for full-term installments, and they were often late to do so, resulting in their children being turned away from school or not being allowed to sit for exams. To improve the situation, we developed a solution which allowed parents to save up for their payments by depositing small amounts regularly with mobile money agents that were present at the school. And this built upon the existing behavior of paying small amounts to the headmaster as and when parents received or earned money. And the idea here is that the data on deposits and deposit frequency might eventually inform other financial services down the line. And finally, the end goal is really to test whether formal financial providers or investors are willing to fund or invest in solutions for the customers, the employees, or the suppliers of these businesses based on the data that's been digitized to date. So here we're interested in learning and understanding about the degree of risk that providers are willing to take on using new or alternative data sources, such as school payment history, and which types of providers are willing to experiment to reach new customer segments in innovative ways. And next slide, please. So similar to the Catalyst Fund, we employ highly integrated teams to work with our FIBR partners so that we can really complement the teams of those partners as well. And this is the example of Namanini, one of our partners that we worked with in Ghana to build an airtime loan for small agents and merchants. So this includes everything from the lean product waltz, a term which our colleague Matt coined to describe the interplay of our consumer insights and data teams in product development. It includes receiving insight on the regulatory environment and what this might mean for building innovative solutions. It includes understanding the ROI of new products through the business case. And then finally, but not least, understanding through the Finance for Life team how finance can actually achieve the end goals of customers, whether it is keeping children in school or growing businesses. And next, I'll pass it off to Abby so that she can talk a little bit more about our pay-as-you-go work.
Thank you, Sushmita. So this year, the FIBR team, we've been focusing on the PayGo Solar sector with the support of many of my colleagues, as Sushmita just pointed out, and a PayGo expert, Jacob Winicky, and he's been quite instrumental in effectively deploying these products. Over 1 million PayGo Solar units have been sold in the last 4 years, and over 40,000 are installed every month. And for those who are new to pay-as-you-go, it's a financing model that enables a low-income household to take home a very high-quality solar home system by paying kind of an initial deposit, and typically 10 to 20%, which ranges about 10 to 20% of the total cost of ownership, and then committing to a certain number of ongoing payments by signing a solar lease with a PayGo operator. Ideally, a customer will make daily, weekly, or monthly payments through a mobile money account. However, that does vary, and that's one of the kind of pain points that this industry is experiencing. And ultimately, the PayGo customer will own the product. What we're seeing is that many of these PayGo customers have limited or no prior experience in the formal financial sector, and PayGo can be a very beneficial entry point to accessing other livelihood improving devices and hopefully some other digital financial services. We're focusing on how to leverage this customer data and payment histories in order to deploy DFS through these kind of more established channels. In addition, we're seeing that PayGo offerings have been impacting the adoption and usage of mobile money. However, these models are relatively young and complex, and they require a pretty sophisticated combination of hardware design, manufacturing, software, sales and distribution networks, customer service, data, big data and data decisions, and consumer finance. And so let's jump to the key industry challenges. So since this is a young industry and a complex one, there have been a number of industry challenges, and the FIBR team is aiming with our project partners to begin addressing a number of these. So new approaches to assessing risk at point of sale, measuring portfolio performance, and driving payment behavior post-sale are really critical for off-grid consumers with limited or no formal financial experience. So we are hoping through FIBR and our project partners to dive into these rich data sets using data collected from touch points, product usage, and other payment data to begin designing smarter field force deployment of these agent networks, target incentives to drive customer selection at point of sale in order to ensure that there's real alignment between what consumers are expecting and how agents approach the consumer base. And as companies begin to expand into areas with lower mobile money infrastructure, which is an issue we're seeing definitely in Ghana, a bit in Cote d'Ivoire, Tanzania is a bit better, but all of our pay-as-you-go providers are navigating this. New payment and agent solutions are required to reduce payment frictions for customers in these areas. So we've been exploring the development of new payment and agent solutions in order to kind of reduce some of these frictions for consumers. And also, we're seeing that the rapid early industry growth has led to customer and agent churn challenges in some markets. Companies are racing to build these data and operational systems to grow sustainably, but navigating high drop-off in churn has really been problematic. So digitizing sales and service touch points with customers has been a real focus, and deploying these kind of prototypes into the market is how we're beginning to address some of these and try to improve agent retention through income shaping and boosting enhancing activities. The PayGo model is also inherently capital intensive, requiring very new approaches to accessing local capital, which to date has been quite difficult, given the business model complexity, and working with our PayGo providers to tap into local capital has been a key focus of ours, and beginning those conversations. And more traditionally, to date, they've been accessing capital mostly from the US and the EU. And now I will hand it back over to Sushmita to talk a little bit about our actionable research and how also we're kind of looking at this space.
Great. So finally, we have a few research projects which are meant to inform and underpin our work with partners. And as one example that we will talk about right now, FIBR and CGAP actually collaborated recently to conduct joint research with low-income consumers of PayGo devices to understand why these customers were investing in these devices and how they were affording these investments. And the full results will be released towards the end of this month or early December in a forum note published by CGAP, so look out for that, along with accompanying blogs, one of which is already up. First and most importantly, households invest in solar to escape darkness, but both literally and figuratively. So literally, solar provides better quality lighting and safety compared with the alternatives that households were using before. But figuratively, households talked about the benefits of exposing their children to the world through radio, through news or TV, of feeling connected to the wider world, of being able to keep up with current affairs. And these are benefits that we have yet to see captured in other PayGo studies. Secondly, the ability to pay over time does contribute to its affordability for low-income households, many of which would not have been able to purchase one otherwise. And it also allows households to test the quality and warranties beforehand and before making a commitment. And in terms of being able to afford these assets, we saw that many households were actually expanding their budgets temporarily to expand PayGo assets and to achieve the sources of value that we talked about above. But they definitely do see this as short-term and that ownership is key. They don't see PayGo as a service. They understand that the service is coming from the sun, and so that ownership is key to the ultimate objective. And going to the next slide, if you'd like to learn more about FIBR, you can check out our website where all of our publications are located, and I'll pass it off to my colleague Asheril.
All right. Thank you very much, Shushmita. So my name is Asheril Amin, and I'm a senior associate at BFA working in the Fintech practice area. I will be talking to you a little bit about this project called OPTIX. It's a little different from the ones that you've heard about so far because it talks about 4 more traditional financial institutions in emerging markets. There is Bangladesh, Mexico, Vietnam, and Colombia. I do apologize, but to whoever's managing the slides, I don't have thank you. Next one. It's the footprint of it is about almost 1 million clients, and OPTIX in itself stands for optimizing performance through improved cross-sell. As I said, these institutions are quite brick and mortar, very traditional, almost as traditional as they come, but they were chosen for a couple of very specific reasons. There was an extensive selection process about 2 years ago, and these guys stuck out because they were solid mid-level financial institutions which were serving low-income clients and communities very well. They had a suite of loans and savings offerings, as well as a bunch of other financial and non-financial services. They had a demonstrated commitment to the double bottom line, but most importantly, they had a desire and capability to essentially take their services to the next level. And so most of OPTIX is structured around this idea of cross-sell, which is essentially what we understand it colloquially, right? It's the idea that if an institution provides the appropriate instruments, then a client will probably end up using more than 1, 2, 3, or more financial instruments from that institution. And so OPTIX goes about trying to work with the existing clients. So new client acquisition is not necessarily a core component of the strategy, but works with the existing suite of products as well as looks at new ones to make sure that they are actively used, that the products are efficiently designed, that there's a natural progression if you want to move on to a more sophisticated version of the product for a particular need. The idea being that an institution, if it does what it does well, And if it is relevant to the client's needs, will end up serving a larger portion of the wallet share of an individual. A lot of optics is structured around this concept of pathways, which are essentially interventions. And we choose the pathways to always have two specific things that are true about them, right? One of them is that they have to be evidence-based, so not do something just because there is some kind of obscure strategic imperative to do it. Someone came up with that. And also that the project has to potentially be standalone once optics is done, right? So that the institution can carry on without the support of the grant funding that comes with the optics project. So as you can imagine, a lot of the interventions that we ended up designing with these institutions together are very technologically inclined, because pivoting on technology is key to achieving a lot of the efficiencies that we're shooting for around the cross-selling of products with these institutions. And there's a whole lot of heavy data analytics involved in that as well. So before I dive into the specifics in the next slide, I will talk a little bit about the general optics play, if you like. And this shouldn't be a surprise to most folks. The idea, it's just that in optics it is very, very structured and enforced in a way, right? So in the first phase, there's a lot of evidence gathering. There are exhaustive segmentation exercises that are undertaken by taking entire dumps of data that these institutions sit on, doing business case analysis, making sure we know exactly how much it costs to service a loan in a group setting versus perhaps a transaction at a branch, spending a lot of time talking to consumers, both through large end surveys and focus groups, talking to the staff, often a neglected part of this equation, because they are key to executing whatever strategy folks come up with, and then of course making sure that there's alignment with the board's mandate or vision for the institution. And so that gives us a very good idea of where the institution is, but then also what some of the problems are that we need to address, right? And therein comes phase two, where there's a lot of conversation around developing a cross-sell strategy around one specific hook product, if you like, right? So it could be a term deposit product, it could be a group credit product, etc., etc. And design a intervention acknowledging all the possible barriers and challenges that could show up as we try to go from one version of the product to another, and how we engage clients, etc. And then, of course, in phase three, there's implementation, which always starts with a pilot, a limited a version of the exercise with a very specific go, no-go decision point. These last anywhere between a month and 6 months, depending on the complexity, the sample size we want to deploy, etc., because as you can imagine, throwing a rather not necessarily complicated but involved technical solution into an institution that perhaps was not always very technically inclined can have its own set of challenges. So in the next couple of slides, I'll go through sort of three versions of some of the fun stuff that came up. First, in this slide, we'll talk about a specific product. Then I'll introduce one or two techniques, and then finally round up with some of the ancillary concerns that come around taking a fintech approach to cross-sell. So in this particular slide, we are looking at an app that is designed for loan officers who have the conversation that allows our Bangladeshi partner, Sajida Foundation, to open term deposit products for low-income clients. Now, term deposit products for a low-income client in itself is a somewhat challenging proposition, because we're talking about extending on the notion of a meaningful lump sum, which is often, how we understand savings to be, if you like, a la Stuart Rutherford, and then taking it one step further, making sure that they keep it in that term deposit product for a period of time and accrue the benefits that come with it. And this really required a orchestration of multiple practice areas at BFA. To give you a couple of examples, on the top right, you have, it's a little difficult to see perhaps, but there are those yellow things which are actually stars. And the stars allow, or the stars are supported by a targeting algorithm that is very much informed by the business implications of these term deposit products. One of the reasons this product was defined was we realized after the deep dive that the term deposit balances were a fifth of where they needed to be break even. Of course, Sajida, as a double bottom line institution, is okay to cross-subsidize this somewhat, but not at that level. So then the 3 stars are the individuals in a group who have saved a lump sum, who have not withdrawn over a period of time, and the amount is over the break even, right? So these are the individuals then that it makes sense for the institution to go and say, why don't you take the amount you've saved in your current account and flip it into the term deposit, because then they get a higher interest rate. They've demonstrated they can keep the money aside very probably for an extended period of time. But then Sajida also gets guaranteed funds for a longer period of time, asset liability mismatch, addressing a little bit of that, right? Then this is triangulated with consumer insights, which you can see on the top left. These conversations really have to be about goals, right? If the amount does not have a mental mapping to a purpose, then the money seems to slip out much more quickly. So using both cluster analysis on MIS data as well as the large N surveys, but also validated by focus group findings, we came up with these 8 key goals that the loan officers structure conversations around. And then finally, you have the quote-unquote inclusive fintech approach, if you like, where the intervention has to be specific to the situation of the client. Everybody will have a different amount of money, a different amount of term that they want to save for. And these simulators allow you to do that. Specifically, in addition to the income generation conversation, it is also possible to have a conversation something like, okay, if I need 10,000 taka in 2 years for my son's exam fees, how much do I have to save now? And it turns out maybe it's 8,900. Well, folks will round it up to 9,000, and then they keep it for 2 years. And in an interesting kind of way, that creates a bit of a light loss aversion situation from behavioral economics, if you like. They're not really losing actual money, but the mental mapping is that I put 9, I'll take out 10, and that adds another barrier to take the funds out. So that's a product approach, for example. And there's this whole other angle that I'm not going to go into because that's a fascinating but rather long story in terms of how heavy data analytics also supported a lot of these interventions. So that's the product. In the next slide, I will walk you through 2 specific approaches to how specific technical approaches are taken. The first one is telemetry. Every single app that is designed, and there are a few, there are 2 financial advisory services app that you saw in the last slide, in Bangladesh and Vietnam, that are happening, and then 3 micro enterprise loan origination applications that are happening in Bangladesh, Vietnam, and Mexico. Each one of them have embedded telemetry. So every time a loan officer does something, we know when it happened, where it happened, every single data point that was collected. And that allows us to go back and actually look at whether the app was being used properly as designed. And if not, whether that is because the staff members were not trained adequately, or whether there's actually something else there that requires us to change the approach that we're taking. And that's one of the nice things about this project, that it allows us to fail fast and fail often, especially with the fintech approaches, so that we can rapidly iterate during the pilot phase and then deploy something after the go, no-go decision, which is quite robust and tested. So in this case, on the left, you can see the financial advisory services. The green boxes are when people are actually talking about savings, and the blue boxes are when they're doing other things. Different story, but fascinating in itself. In the second one, we're looking at how long you have a conversation for. Interesting decay function. The longest conversation this individual had, this loan officer, in the 3 months that this data is from, was 45 minutes. The next one is 20. There's a whole bunch of them after, which are between about 10 minutes and so on. So when we see someone who talks for a very short amount of time, and these are conversations that we can track, we know there's something else going on. Another example is using geospatial data, which, there's the usual vanilla stuff around making sure that if you have a mobile money agents situated in a nice distributed proximity to microcredit groups. The example that you see here is a little bit more interesting, where the challenge is our Vietnamese partners have to service groups that are very, very far away from each other. And so this loan officer has to be on a bike with a jacket and collect the money, a motorbike, but still collect the money, put it in the pocket, and either when the mandated maximum amount is reached, or literally when the pockets are overflowing, they come back to the office, drop the money off, and go out again. In the particular track that you're seeing, if you follow the red one, that is one individual on one day. The little black dots are the centers where funds can be collected from, and the little purple pins are the mobile money agents. And I think you can already see visually how you could play this game of connecting the black dots and the purple pins, and then come up with a much more optimized route. And that is exactly what is happening from an algorithmic point, so that this is exhaustive, right? So the institution can service many more centers within a given period of time by using these mobile money agent points as cash drop-offs, which of course opens its own set of interesting problems, because you have to have a partner who wants to allow that kind of transaction, that amount of money, et cetera, et cetera. So in the last 2 or 3 minutes I have, let me walk you really quickly through some of the interesting challenges, if you like, that we face as we try and take 4 brick and mortar institutions on the next slide through this process of embracing fintech. So the big picture angle is, these are brick and mortar companies, and I think we hear now and then how they're doomed to extinction, right, because of the evolutionary onslaught of fintech-based microcredit. And we think these 4 OPTIX partners actually illustrate that even the most brick and mortar financial institutions have a fighting chance to pivot and embrace fintech interventions. They do face some unique challenges, though, and in a lot of cases it could be because a lot of these interventions are like mixing oil and water and really require some amount of soul searching. There are difficult questions you have to answer. Like, if you bring a digital intervention to a group-based microcredit model, does it actually destroy the social cohesion that is supposedly central to the functioning of the group? If we introduce an app to do microenterprise loan due diligence, which is difficult enough already for a microcredit institution to do, microenterprise, does it erode or remove the value judgment that is very crucial? Value judgment of the loan officer who's on the field talking to the individual, that is very crucial to and a part of the system. And even further, if the institution actually embraces machine learning models, then is there a way in which we can make sure that the algorithm is accountable for the way it gives its predictions, or if it is way too black boxed and we wouldn't know if it is actually causing bias or spreading false information, right? And so there aren't necessarily very easy answers to these, but there are certain things that can be done to make sure that all the hedges are in place. And the last thought to leave you with, and kind of circle back right to the beginning, is I think you'll remember Melise talked about the Stockman. Well, they turn out to be one of the partners with one of our institutions, the one in Mexico, Acromex, because not all, even though the financial institutions have been great in embracing fintech, they can still not do everything on their own. Right? Obviously, they have hundreds of thousands of captive audience, a dedicated staff, area expertise, but the technical solutions and the skills that you need to actually do it right are often much better offered by pure fintechs, like the Stockman with their alternative credit scoring, or Juntos with their SMS-based interventions, which they will now work with our Colombian partner to try and improve savings balances. And that then, in a way, brings this conversation full circle to say it's a fascinating world of trying to get brick and mortar financial institutions to embrace fintech, but often it has to be done in partnership with some of the trailblazers in the field that you heard about earlier on. But let me stop there and Carmen, see which questions you'd like me to take.
Ash, we have a question from Janet. What are the biggest differences in the cross-sell strategies for low-income customers compared to medium or high-income customers?
Sure. So it's essentially the fundamentals are almost similar to what it would take to make sure that one product makes sense. So there's the business case, for example. Different products have extremely different business case profiles in terms of the transactions and the balances that they can support to make them viable. And sometimes the sum of the parts is not necessarily greater than the whole. One can pull down the other depending on the kinds of dependencies and interactions they have. So that is crucial. Another one often is that these institutions are extremely staff intensive, right? They have folks going out into the field, talking to individuals and all of that. But in some ways you can see how, they can be somewhat, the capabilities essentially can be somewhat different than if you wanted to do financial wealth advisory services at a Bank of America, for example, right? And so the tools in the toolkit of an individual who's going out has to be particularly tailored to that situation. Let's see. So let me stop at those two. And of course, outreach is another one. There are familiarity with technology. So some of the stuff we're doing around mobile money requires a lot of familiarizing individual clients with how to use mobile money to pay loan installments at an agent, whereas perhaps for someone who is super savvy with a smartphone, it comes much more naturally. So yeah, a whole bunch of different challenges show up.
We have a question for FIBR. So much of the activity in the financial inclusion industry is concentrated in a handful of countries. Kenya and Tanzania in East Africa, and Nigeria and Ghana in West Africa get much of the focus. What options exist for these entrepreneurs who operate in less popular countries? Do people in Guinea or Malawi just have to wait?
Sure, that's a great question. I would say in terms of FIBR is a research and development project which is starting out in Tanzania and Ghana, with the idea that the lessons learned can be exported to other markets as well. And many of our partners are actually working across markets, so not just in the Tanzanias, the Kenyas. For example, one of our partners, PEG Africa, is working in Cote d'Ivoire and other markets as well. So we hope that many of our interventions will inform their work in those markets as well.
And a follow-up question to that is, what research or options exist to improve financial inclusion for underserved individuals in countries like the US, the UK, Canada?
Great question. So BFA's focus is on more developing markets, but one of our partners, the Center for Financial Services and Innovation in the US, actually does complementary work in the US and other Western markets. So we do talk with them quite a bit, especially around their work related to financial health.
Yes, and if I can add to that, Carmen, even for Catalyst Fund, answering both questions, we are seeing that many of the deal flow is often concentrated in some of the largest and most mature in terms of digital solutions and more efficient markets. So one solution that we're putting forward is, for example, trying to partner with local accelerators and other players in all markets, so that some of the solutions and the toolkits can be shared with those entrepreneurs as well, and that you can have some of the ripple effects of the learnings that we're having from the markets such as the Kenyas and the Tanzanias. And then in terms of what is available in, for example, markets like the US, in CFSI, the program that Sushmita was mentioning, is partnering with a program also funded, for example, by JP Morgan called the Financial Solutions Lab. And that focuses very much on promoting startups that work to improve the financial health of low-income, underserved Americans. So you do have some some innovative programs in those markets as well.
And then this is a question for all the panelists. How often do solutions struggle due to regulatory constraints? Or is there enough that can be done within the existing regulatory environment too?
So I can go first, but then would love to hear others' perspectives. There definitely are regulatory constraints, but we're seeing that there is still a lot that can be done basically within the frameworks, and especially in the early days of testing and new ideas. You don't necessarily hit immediately against the regulatory walls, but obviously as you reach scale and you want to extend also to other markets, you will have those issues, but there's still a lot that can be done within the existing frameworks, and a lot of improvement that also could happen.
Yeah, I would.
Go ahead, Abby.
Oh, thank you, Ash. I would agree with that. It's definitely been, I mean, that is also why as kind of part of the FIBR model is to engage financial service providers early so that these fintechs or startups can begin accessing kind of those institutions and kind of working with them to deploy more effective products through these channels. It's definitely hard early on when we're piloting and these financial service providers are not necessarily on board. We've definitely had to navigate it effectively, and we work with a team in order to understand the regulatory landscape before we deploy this in order to ensure, you know, the safety of our partners moving forward. And we do take into account both kind of, sorry, you noted that I see to ensure, you know, customers understand the implications of the data they're giving up. We are worried about customer identity throughout this process and ensuring that, you know, consumers are protected, you know, as they enter the formal financial system. And I'll hand it over to you, Ash.
Thank you. And then just to add to that, there's certainly a sense of, you know, a bit of a wild west, if you like, especially in certain jurisdictions around regulation, because things are so gray when you're a pure fintech play. It gets a little bit more complicated if you're a traditional financial institution coming in, which usually has a whole slew of regulatory requirements they have to satisfy. And that's when there's a lot of careful balancing and, frankly, consulting with the regulators that comes in. Because in many of these countries, the regulators are able and willing to have the conversation, but someone has to set the agenda. And so, for example, in Mexico, one of the recent concerns we had was around, can a brick and mortar institution actually share client data with another institution to get alternative credit scores? Or in Bangladesh, where a recent change in mobile money caps really caused some disruption around the financial product that was designed and actually had just started to get deployed. But then we have to understand that these are responding to greater macroeconomic concerns or situations. And so there's a lot of flexibility, but a lot of conversations essentially that need to happen.
Yeah, and piggybacking on that, to answer the last question that was posed by Chris, have your programs sought to embrace or push regulatory sandboxes? We actually do believe that also the regulators themselves need support and a push. And so recently, we've actually developed a project called RegTech for Regulators Accelerators, R2A, that you can check out. It builds sandboxes, not for the startups, but for the regulators, in the sense that it's trying to help the financial sector authorities in different countries pioneer the next generation of tools and techniques for market supervision and policy analysis. So we just opened a competition for companies to submit their solutions. And the idea is that they'll be tested in these safe regulatory sandboxes so that then you can empower regulators to really understand the marketplaces, customer experiences, and the consumer needs, and find better regulatory solutions. So if you want to learn more about that program and the insights, you can visit the R2A website as well, on the BFA website.
Another question to all the panelists. Talking about legacy, long term, how can each of you and the rest of us in this sector ensure the competition between each other doesn't get in the way of the social mission of these startups and of our own organization.
You mean competition between our own like consulting firms like BFA?
Yes, and also the fintech startups that you work with.
Yeah, well, luckily the startups we work with are not really direct competitors because they work in such different markets. But even when they are, I think in FIBR, maybe you have other examples you can talk to. There hasn't been an issue of competition, but rather actually learning from each other and growing. There's definitely still enough space for all of these solutions to be in the same markets. So that hasn't been a problem so far. And in terms of companies like ourselves and others in this space, we definitely embrace collaboration with others. I think there's so many different approaches that have been tested, and we should all learn from them and be better at sharing the insights and sharing what works and what doesn't. There's no reason to compete if we really are committed to making a dent and advancing financial inclusion worldwide.
Another question, do you see big tech companies such as Facebook or Amazon moving into emerging markets to provide financial services too soon?
Yeah, I mean, to a large extent, that's already happening, right? So specifically in terms of Facebook, there's this instance where they deployed a recent mobile money solution in the Philippines, a very fertile ground for testing fintech solutions for a while. And you have a lot of the Chinese firms, the ants coming in into India and various levels of collaboration. So there's absolutely a lot of down market stuff that's happening. There's a lot of embracing of technologies offered by upmarket companies, so maybe even Watson, by online lenders in Nigeria, for example. And then you have the pure plays from the bottom who are reaching up and developing their technology to a level where they might get acquired or have strategic collaborations with these institutions. So I think, I mean, the answer is sort of absolutely, and the flavor in which it happens are many, many, many.
So we have two last questions. Do you see differences in terms of fintech development? That is the level of maturity of various sectors, such as payments, credit, investment, insurance across continents? What are the key differences in which fintech can accelerate financial inclusion in Asia versus Sub-Saharan Africa or MENA, for instance?
I can go first. Yes, we have seen differences in terms of the maturity of the fintech sector in various countries, and that's primarily enabled by existing ecosystems and infrastructure in various countries. So, for example, in Latin America, where you have much more established financial institutions, you have a lot more of B2B type of companies and companies that really focus on product innovation, or for example, the alternative credit scoring, and there's a lot more data available. But in versus Africa, though, where in some countries like Kenya, obviously the payment rails of M-Pesa have enabled a lot of innovation to happen as well. So those infrastructural differences do lead to differences in what fintech solutions are offered across markets. In terms of the products, it also depends on the inherent business model. So we've seen a lot of mobile credit companies. InsurTech is also very popular these days and a lot of potential. But I do think more diversification will happen over time. But it is a combination of those two things, like infrastructure, enabling infrastructure, and then the business models given a certain demand in a country. I don't know if Sushmita or Ash, you want to add anything?
I mean, the only thing to add is specific to the question, just to point out that the differences are precisely more at a country level than Asia versus Sub-Saharan Africa versus the MENA area versus Latin America, because Kenya is still very different from Tanzania, and yet the same companies have tried very similar stuff, even with somewhat similar rails because the ecosystem, the need, the consumer demand, et cetera, are different. And even inside a country, there can be variations, right? So it's more, the differentiation is almost at a more granular level.
Yeah.
Yeah, and from the fiber level, in terms of consumers' access to smartphones and what we can do either from the consumer level or from the business level, for fiber specifically, the idea was to work with the smartphones that businesses have, because we know that smartphone take-up is still expanding among consumers, whereas I think in Latin America, consumers already have smartphones for the most part, and so this approach wouldn't make as much sense there.
I just wanted to chime in very briefly. This is Daryl Collins, and just to take us back very briefly to the super platform question, which we've been thinking quite hard about, not necessarily in these 3 projects, but elsewhere. And the potential of some of the super platforms, particularly those coming from China, is very enticing. And to think about how the challenge there for our sector is how do we actually make sure that those super platforms are being used for good purpose in the lower income segments and not just reaching down into the middle income segments. So we're exploring some work in China, thinking about how to use aggregation points to access super platforms. We're also thinking about how do you use super platforms to leverage financial services across the various points of service that you need for better sanitation, better housing, better health, better education. So this is something that we're quite actively engaged in, not necessarily in these projects, but certainly in future work that we're exploring.
That's it for today. I'd like to say thank you for attending our webinar. We hope you enjoyed it. Please take the poll about future webinars. And if you would like to learn more about BFA, visit bfaglobal.com. Thank you for joining us today. Goodbye.
Thank you.
Thank you.
Thanks, everyone.
Thanks all.
Bye, everyone.